full
screen?
Your other stuff too.
I'm sorry. Hold on.
For joining us today for this webinar to go over our three major pieces of legislation that are designed to increase funding for affordable housing development. Robert, for the introductions, for those of you who just joined, we have Tyrone Buckley, who is an advocate with Housing in California, Marina, Wiant, Policy Director at the California Housing Consortium, and the two of us will be covering AB 1335, Speaker Atkins' Permanent Source Bill. And we have Matt Schwartz, President CEO of CHPC, David Dolagite, Housing Consultant with CHPC, and Mike Lane, Policy Director with NPH, to give some technical details about SB 377 and AB 1335. Advance the slides, please.
Mm-hmm.
Okay, great. So we just wanted to provide a brief summary and lay of the land about the housing crisis and the talking points that we've been using in our lobby efforts in the Capitol and throughout the state. As many of you know, we're in a terrible shortfall of affordable housing. CHPC released their report earlier this month highlighting over 1 million houses that were short in the state of California to house low-income. 3 Californians has no stable place to live. All state and local resources have dropped 79% since 2008, and this is really one of the most salient pieces of evidence that we've been using in our advocacy efforts and to justify these bills that we're talking about today. And as all of you know, until the production of affordable homes continues to keep up with demand, California will continue to face the highest poverty rate in the nation. And Rob, a lot of evidence on the intersections between affordable housing and several other important policy areas, including environment, business, health, education, and public services. And for those reasons, as we've been advocating for all of these bills in the legislature, built a very large coalition of supporters that includes stakeholders from all of these industries. Particularly, the business had great support from the building industry, several chambers of commerce throughout the state, and as Matt he won't really cover, but on the bills related to the tax credit, we do have support from the chamber, which is a huge coup for the affordable housing community. Slide. Is the Speaker's bill on permanent source of housing. I'm going to kick it over to Tyrone, cover the basics of the bill, which already are well aware of, as well as some of the important differences between this bill and SB 391, the Desaulnier bill from last year.
Thanks. So Tyrone Buckley, Housing California, talk to you a little bit about the AB 1335, the Atkins bill, and this bill is part of our running fight for a permanent source for housing funding at the state level. That's been a priority for housing advocates for years. Last year, the effort was the California Home Jobs Act, SB 391, which was shepherded by the author Senator Mark Desaulnier, and it got out of its first house, which was one of the most successful efforts around a perm source, but unfortunately died in a probes in the next house. So that's been a big challenge, but this year we're very excited that the Speaker of the Assembly has identified very early on that affordable housing is her #1 priority, and as a result has decided to author this year's permanent source bill, AB 1335, which is structured much like last year's bill. And this is not necessarily a novel proposal. You can go to the next slide, Robert.
You got it.
Novel approach. It's a common public policy strategy to trying to fill gaps in affordable housing funds. Four other states have capitalized housing trust funds. We've had our housing trust fund here in the state of California since 1985, and California is one of the 6 states that have housing trust funds, but don't actually have public revenues that are committed to them. And this bill seeks to address that problem in particular. The State Housing Trust Fund will leverage $6 of federal, local, or private funds for every $1 of state investment, which it goes a long way to justifying that fee and demonstrating to everyone how much we can leverage out of that. And we are trying to model other states that have real estate transfer taxes to fund their trust, and the list of those there, and then 9 other states that use recording fees. So, slide please. Oh, there it is. Never mind. No, there you go. So what would AB 1335 do? As I said, it was modeled after last year's SB 391, which levies a $70 document recording on real estate transactions. Much of the resistance we got to the recording fee last year, and when it was SB 391, was that there was this notion that that the state transactions would create all these documents, and therefore the fee could raise to an astronomical number. So this year, the speaker decided to cap how many document recording fees could be assessed at $25 per parcel per transaction to alleviate some of that. In all honesty, I think most of the estimates were that most real estate transactions don't actually go above 3 recordings. So it's just one of those things that I think was done to make sure that that argument about there being an astronomical cost could be muted a bit. Part of what happened in a previous iteration of the bill was that all real estate sales were exempted from the fee. So that means that any buying of a home or commercial property is exempt from the fee, and was to make sure that was to alleviate some of the opposition. The California Association of Realtors, which had been the primary opposition to the bill, the goal was to position, and it did for a while, but it didn't permanently. But we'll get more into that in a moment. And typically, this fee is going to be paid by homeowners when they're going through refinancing, and by entities that are filing notices of default, so often banks and businesses engaged in various real estate transactions, such as record all of the documents that they need to go through building processes. And it's important to note here that the California Building Industry Association has been in strong support of the bill, recognizing that that their constituency will be paying a lot of those fees, but they also recognize that the need for affordable housing is so great, and the need to fund it at all income levels is so great that it offsets the impact to their constituency. Next slide, please. $35. Also, as part of making the realtors were in support of the bill, there's a 20% set aside for owner-occupied workforce housing. So that was inserted in the bill very recently, and the realtors aren't the only folks that were advocating for that. Our friends in the affordable home ownership world, like Habitat for Humanity, we're very excited about that as well, and a lot of our folks in the rural communities who do that type of work were enthusiastic about that. But the funds would be available for development, acquisition, rehab, preservation of rental housing at people who are low income, very low income, and median income. And this includes supportive housing, emergency transitional housing, and rapid rehousing. The hope is that much like redevelopment, which we lost in 2012, that this fund could be used as a gap filler, as redevelopment was, for those costs that are difficult to cover from other funding sources. Pieces that, again, was to our opposition, particularly realtors, again, is that there's going to be a process where there will be an investment strategy approval. So there's a fund governing board that's established through the bill, and some of that language is already in there, but there's the current language is advisory, so it established this trust fund governing board made up of 12 people from different industries and also some public members, but advisory, and the idea is that it's likely to change to be a board that has authority to approve which projects receive funding. So that'll probably be the final step in making sure that we get all the folks with this bill that we need in order to get it passed this year, which, with, like I said, with the leadership in the Assembly as its chief author, we think we have a great chance of getting this done this year. And so we're hopeful, and I think that wraps that up.
Covering at the end of the presentation of all three bills, this next steps for all bills and what you all can do in your local district. And I will pass it over to Matt.
So we're going to start with Senate Bill 377, and Jim Bell's the author, and the slides that have been sponsored by the California Treasurer's Office, John Chung's office, and partnership. This is an area of that Mark in particular has been working on for many years, which we also have wanted to work on, which is how to make the fact that state taxes are essentially paying a federal tax on a precious affordable housing resource. So, genesis of the bill, there have been attempts in the past to try to tackle this, unsuccessful, but with the help of a number of people, we've been able to come up with an approach for this year that we're going to cover in these slides. So, and this is just a review of what a state tax credit is. So I'm going to keep going, but for anybody who hasn't had experience, remember it's reducing taxes on a dollar-for-dollar basis for the taxpayer. Next, please. Preview the state low-income housing tax credit created in 1987 as a complement to the federal income housing tax credit. Awards made through the Tax Credit Allocation Committee, and the original design was to help balance the fact that the U.S. Department of Housing is able to designate certain areas that receive additional federal credits, and that leaves out a large part of the state. So the state credit was originally focused on trying to make sure that other areas of the state are really disadvantaged. And a perfect tool, it's done a pretty good job of that. Next. So defines the California tax credits in the Revenue and Taxation Code. And says that when it was started at $70 million a year level with inflation, and is currently at about $94 million a year. And of course, the Allocation Committee gets to exempt to this they use each year, and sometimes it's a slightly greater amount, slightly lower amount. They have backings, or if they forward committed. And the last is that only a very small portion of it is really available for use in leverage federal 4% back to at a later point when we talk more about AB 35. Next slide, please. The simple version of what this bill would do is that the credits, this credit changes allows it to be certificated and sold separately from the federal credit and separately from the ownership entity. Again, we're noting that currently, because of subjectivity to federal income tax laws, roughly 30% of every dollar that the state is investing is being taken by the federal government. And again, that's a tax penalty we want to get rid of if we can. States have certificated their credits, a variety of credits, can be sold by nonprofit organizations without paying federal taxes, nonprofit exemption from federal income tax. Next slide, please. Here is that trying to boost the value of the credits. We can actually boost it from 65 cents on the dollar to 85 or 90 cents on the dollar. Why 100 cents on the dollar if we get rid of the federal income tax? We have some value of money issues and also some transactional costs issue. Frankly, that means we can't perfectly capture that 100 cents on the dollar. That's a goal for a future some of you on the phone may be, or in the webinar may be, for-profit developers, and wondering how you can access the source. And of course, you need a nonprofit developer partner, as far as I know, whose main purpose is affordable housing development, but many for-profit developers of tax credits in the state already have those partners, and hopefully it will be a resource that will be widely shared. Next slide. So I'm now a guide who has spent many hours with tax attorneys, and I should also, before I do that, just acknowledge, particularly received the Treasurer's Office from Eugene Cowan and Carsley Emden, and attorneys with U.S. Bank's National Tax Group, who've been terrific and helped write a number of provisions and provide a bunch of the information we'll be covering today. David?
The current California tax credit program functions as federal credit in the sense that it's allocated by TCAC to the taxpayer and property owner. We typically structure either as a limited partnership or limited liability company since it's a tax pass-through entity. Credits are sold via sale of those partnership interests, typically 99.99% of the interest in the tax pass-through ownership entity to an investor, with the investor receiving the credits needing order of the taxpayer entity itself in order to claim those credits. Under law, the state housing credit, however, can be sold separately from the federal credits via bifurcation. Reduce the investor's state tax liability, and since state taxes are deductible against federal income under IRC 164A3, the effect of utilizing the state credit is that it reduces the ability of the taxpayer, in this case the investor, to utilize their state tax deduction against their federal income tax. On an economic basis generally is that it reduces the value of the state tax credit to roughly 65 cents on the dollar, assuming a 35% marginal federal income tax rate on the investor. Next. Illustrative purposes. In this case, assuming an investor with $1 million in gross income, a state income tax liability of $100,000. For a investor that utilizes the state income tax credits, in this case, investor B, they were to pay $100,000 worth of state income tax credits. It would go against their $100,000 deduction that they have been planning to use as their federal income tax return. The effect is, rather than having taxable income of $900,000, they have a full $1 million of taxable income. The result in this example is that investor utilizing the state income tax credit wanting $35,000 more in federal income tax as a result of the loss of that deduction. So 3 is an attempt to work around that problem. Credit the project sponsor can elect certificated. In this case, the Franchise Tax Board would certificate evidencing a right to the credits in connection with development of the qualified low-income housing project. Those credits now can be sold to an investor as if they were personal property from the ownership entity, which means they do not need to be allocated through the partnership. The investor in the certificated state tax credit doesn't actually need to have an ownership interest in the partnership. Certificated credit is now being as personal property by the IRS, and I want to note that the certificated credit that we're proposing here is not redeemable for cash. This is not a certificated credit that can be turned into the Franchise Tax Board in exchange for cash. It can only be used as an offset against state income taxes owed. But since property, it doesn't reduce the investor's ability to take a deduction against their federal income, against their federal gross income for the payment of state income taxes. So potential economic value is dollar for dollar, less transaction costs and saturation. Next. Same as before, but here there is using a certificated state tax credit in the same amount as before, $100,000. Property, they don't lose their loss. So in this case, investor B's federal income tax liability remains the same as if they hadn't credits in the first place, and then they can utilize their state credit certificate separately as payment of the state tax liability. The case basically is that they still have a state income tax liability, and instead of their own cash to pay that state income tax liability, they're using the certificate to pay it. Please. Since it's of personal property to the investor, it does trigger a capital gains tax, just as the sale of any other piece of personal property. And since the certificated credit is issued by the Franchise Tax Board to the sponsor, and the sponsor's not actually paying anything for it, there's no tax basis in the property being received by the project sponsor. So proceeds from the sale of that certificated credit to capital gains tax. The sale by a corporate entity, just as a note, the Internal Revenue Code treats capital gains and income as the same in terms of tax rates. So there's not a preferential treatment for capital gains for corporate entities. So the nonprofit that itself income tax liability by virtue of its tax-exempt status. This of the credit, and given a multi-year stream over 4 years and value calculations, we're looking at something in the range of the upper 80 cents to the dollar to possibly 90 cents on the dollar. The non receive these proceeds and then loan or contribute the proceeds to the partnership for the benefit of the project, similar to deals where we're making general partner loans in the various grants and other subsidy programs. State credits, house credits, historic tax credits, and other forms of investment tax credits. Michigan has historic preservation tax credits they've certificated. Carolina has utilized the renewable energy credits that are certificated, and as you can see, we have Connecticut, Illinois, and Georgia have done so with their film credits.
So this is Matt. The next 2 slides are a response to a number of points that have been raised in various forums, questions and concerns about the proposal ANSB 377. And David has compiled responses, again, consulting with several attorneys who've been helpful in drafting this. David?
Are we on that slide yet? Nonprofit GP provides the equity capital rather than a loan, and their 40-year depreciation would trigger this tax-exempt use property. Our analysis was most likely, but that the cost for the longer depreciation period be more than offset by increased pricing on state credit. of our LIHTC deals here in California, we're often having to use 40-year depreciation already, so that the net benefit's a positive. Alternative, if the nonprofit GP is providing it as debt in the form of a sponsor loan, we treat it as bona fide. In those cases, we have to structure just as any other loan into the partnership as true debt to satisfy the 55-year test. Most folks on the phone here have experience with deals where we had to do this, so it's very, very common that we're having to do this for other forms of grant income. We're also the debt is allocated. Well, the debt will be allocated to the nonprofit GP. The nonprofit debt is disaffiliated. I think the government says it should not be an issue for most deals, but if it is, we're finding, I think, a number of sponsors we know we've been with here at HPC are increasingly having to disaffiliate, becoming more common on deals involving nonprofit debt. Next. To disguised ownership by the IRS. The advice we have is it will be an issue in California, since on a lot of our deals, almost there's a nonprofit involved in order to qualify for the welfare tax exemption, and with the nonprofit serving as a managing GP in these deals, and structured in a way that the managing GP status of the nonprofit is substantive. And as long as we have that situation with the debt structured as true debt, resolve this concern. To the nonprofit partner, there were concerns that it would be treated as private enormement, that is, that the tax-exempt status of the nonprofit was being used for private benefit for a partner. And I think the key here that we got on the feedback that we received is, since the proceeds that are being used are arising from the development of the low-income housing project itself, and that the credits itself are being generated by the project, that it should be in furtherance of the nonprofit's charitable purpose, assuming that a component of the chartered mission of the nonprofit is the development of low-income housing, which would be the case in most of these projects. We has a certificated state housing tax credit that the statute in Massachusetts allows to be transferred to a nonprofit, which then sells the credit and loans them to the partnership in a structure similar to what we're proposing. Being used quite commonly there, and has successfully helped deals in that state to make 4% deals pencil out. And that is where it's primarily being used. To certificate the credit, and they don't, it will just be an option under the proposed under SB 377. So the option to certificate is at the option of the sponsor. You can still receive the credit as an allocated credit if you don't want to go through the certification process.
As we go to the next slide, I just want to reiterate that point. This is Matt Schwartz again. Thank you, David. That this office has been really clear. The author is really clear. This is not being imposed on anyone. This is not. If you have it, great. And if you can't, there's no harm to anyone you can't. It's about eliminating the federal tax as much as we can on a precious state resource. So to Assembly Bill 35, you can see the sponsors who I think are well known at this point, David Chiu and Tony Atkins. And this is, as Marina and Tyrone mentioned, part of the leadership package. And you see that all three of our organizations, four, are sponsoring this. The image for this proposal comes recognition that many of us have had over the years. While the 9% federal low-income housing tax credit is a per capita limited resource, some of us may hope Congress will someday increase for us. Likely we're going to be stuck with this limit. But this other federal tax credit, worth a little less than half the value, but still, that we access through getting allocations of private activity, tax-exempt bonds. And at least at the moment, there's not any limit on being able to get those private activity tax-exempt bonds because we'll use all of our allocation. Please don't tell the IRS anybody because we don't want to ask by, actually it's Congress to take back some of that bond authority if we don't do using it. So, and this is one way to help us use more of that. So, for many developers around the state, the ability to use the 4% tax credits has been linked to the state program was designed in large part to allow developers to go after these 4% tax credits, leveraging this state resource, which of course is now quite diminished. And the issue is the loss of the $1 billion redevelopment funding and $400 million a year in state housing bond funds we've relied upon. Next slide, please. And here's a display of that. The CD we put together, and you see that we've gone, and well, the chart shows a slight uptick for 2013-2014. That's really indicative of any new funding. It was more reallocating older funding captured. Next, please. A couple of notes. Again, a reminder that currently only 15% of the California credit that we were just talking about is currently available to be used in combination with the 4% tax credits. California credit could be allocated to use with 4% deals, but the position that anyone who's worked in the underwriting of these transactions knows is that value that California credit currently allows per property is 13%. It's capped at 13% of basis. And that's way needed to make deals feasible and certainly way under the boost that 10 credit projects receive. Next. Doing. 85 would expand the annual state credit pool by $300 million for use with 4 transactions only. The logic here is we're making to the legislature, to the governor, that by investing state resources, we're going to be leveraging a lot of additional federal resources. It would be credit rate for both new construction and rehab goes from 13%, the current limit, to 50%. And how the bill would enable developers in California accessing the state credit to leverage 4% credits more effectively. Acquisition basis credit that's currently at 13% would remain at 13%. It's been limited to use with just at-risk projects, and that would be lifted to a more powerful resource, combining it with a high rehab or production credit. Another piece that Michael Lane's going to talk about in more detail a little later, that actually is a greater boost in the credit rate for the story of older properties, low appraised values, which has become a huge barrier to recapitalizing them and preserving them. And the thing we can afford now is to let these older properties go by because we can't find a way to use the tax credit program to reset them effectively. Next slide, please.
The key provisions of AB 35.
Next.
Yep. The projects that are 4% located in a DARE QCT able to receive a 50% credit on new construction and rehab basis. And those projects which are ACC rehabs, they can then also take a 13% credit on their acquisition basis.
So I'm sorry, I got you to go one slide too far. If you could go back, please. Thank you.
Okay. So that Outside the AQCT, projects will get 50% on their rehab or new construction basis and 13% on their acquisition basis. For the DDA or QCT that are receiving the 130% basis boost on the federal 4% credit, they'll a state tax credit that provides enough of total equity between the sales of federal and state credit to put them in positions they would be if they were not in a DDA QCT. It's a pro rata reduction in the credit rate on the state credit to equalize them with projects that are outside of DDAs. And we'll show the math on the next slide in a second. It's a little confusing. Projects will also likewise be able to take a 13% credit on acquisition basis. Through TCAC's competitive 4% state credit queue, like currently, which happens twice annually, similar to the 9% program. Here's a comparison between a non-DDA and a QCT sample project. $10 million in eligible basis on the project. They have a basis adjustment because they're outside of a basis boost area. Presumed federal credit rate based on current credit rates of 3.2% per annum over 10 period generates a $320,000 annual federal credit for $200,000 total federal credit, 4% credit for that project. Sale price of $1.02. Project would raise $3.2 million in total equity on the sale of federal credit. For the 50% state credit, $1 million of eligible basis to generate $5 million in state credits, just over a 4-year period. 5 cents credit price, we get $3.2 million in state credit equity raised for the project for a total of $6.5 million in total federal and state equity. Same project and put it inside of a DDA or a QCT. So in this case now the project's eligible for the basis boost on the federal credit, a total federal credit of $4,160,000, price of $1.02. We get $4.2 million in federal credit equity raised. Well, state credit side, and TCAC will just back into this, and we assume TCAC will come up with a formula that will work out and update periodically based on prevailing credit pricing. The effective state credit rate would have to be effectively roughly 35%, 34.94 in this example, but roughly 35%. Credit, $3,000,004 at a 65-cent credit price to get to $2.2 million in equity. And so into the federal equity secured through the basis boost, you wind up with a federal and state equity raise that's equal to what the would have raised if it was outside of a DDA. And so this mimics the current system where for 4% deals, they're eligible for the current 13% credit only if they're outside of a DDA or QCT, since it's intended to equalize those projects with those that are getting the basis boost. So the AB 35 mimics this same standard to put projects on equal footing regardless if they're inside or outside of a basis boost area. Next slide.
Great. So this of AB 35 was actually was included in the original version when the bill was introduced. We've been working on this piece with Kevin Knudsen at Community Economics, and Kevin's been wrestling with this issue for quite some time. And it's a relatively universe of projects, but as Matt had mentioned, they're not able to generate sufficient credits to be able to do a substantial rehab. And TCAC doesn't want them going through the 9% queue either. And so the idea is there authorization we could give to TCAC to be able to close that gap and be able to make a substantial rehab pencil for older projects, particularly those that are in some cases 20 to 30 years old, SR deeply targeted deals that just don't generate significant acquisition basis because the appraised values or there's no value, or they're negative, or relatively little, can't generate sufficient credits to be able to do that. And so they're just, these projects are out there struggling with trying to find a way to be rehabilitated. Local governments are not particularly interested in investing millions of dollars in these projects, and HCD actually has many of these buildings in their portfolio as well. But only work with 4% credits and bonds, as we note there.
Yeah, next slide, please, Robert.
Next slide. Am I okay? Okay. Here, 4% credit on rehab, 9% state credit to equalize the equity yield, and a language states that only enough credits will be allocated to complete the rehab. And 4% credit, approximately 40 cents per basis. And of course, than that, there are currently bills in Congress to fix both the 4% and the 9% rate, as you know. But the 95% credit, approximately 60 per basis, depending on pricing. Sure, all basis costs, but may still have shortfall. Next slide, please. So what's left for TCAC? We want to give authority to do this and to create a window and a queue. We don't expect that we'll have obviously all the projects go at one time, but just knowing that there's a pipeline and that there's a queue that these projects can move toward, I think gives hope for some of these older buildings. So we'll individual projects in that competitive system, what local value means through the AP process, decide how and how much to allocate. So that's still work to do. The lender will simply ought to provide this opportunity and this window for these developments, and then we'll work on the regulations going forward.
Great. Just to summarize, projected benefits of AB 35, as we said, investing $300 million more in the state resources in the state credit. We project will get us at least additional federal 4% credits and allow us to use another $400 million in additional tax and bond financing. Let's preserve that resource as well. Thousands of in affordable homes, take some 9% queue, as well as letting other projects proceed. And as Michael just outlined, gives a chance to preserve some older, deeply targeted properties in both rural areas that might not have a very bright future going forward. And just, of course, this leaves in place the existing $20 million for balancing DDA QC2s in the 9% program. Again, not to interfere with anybody's current business model, but really to open up new opportunities and the pie for everyone here.
For all three bills is as follows. AB 35, this tax credit expansion bill that we've been discussing, will be heard on Monday in Assembly Revenue and Taxation Committee. Assembly Revenue and Tax Committee has a suspense file, and we expect this bill to be put on their suspense file. And hopefully, if all goes as planned, released from the suspense file at the end of next week or the end of the week. I can't remember the exact date. AB 5 and AB 1335 will then be heard in Assembly Appropriations Committee. 5 we don't expect to be put on suspense, but AB 1335 would be put on suspense, and all of those bills would be dealt with off the suspense file May 28th or 29th. SB 377 will be heard next in a Senate Appropriations Committee. I believe it's scheduled for May 18th.
Correct, May 18th.
And it may also be put on suspense, and similarly, it would be released off suspense May 28th or 29th. All bills need to pass out of the House of Origin by June 5th. AB 1335 is the one exception, as it has an urgency clause. An urgency clause makes the bill subject to deadlines, although we do expect the bill to move sooner than later. Just slide. 35 and SB 377 specifically 35 has enjoyed bipartisan support. I believe 377 as well. 35 passed unanimously through its first committee. We are very excited to see those bills moving along so well. And both bills only require a simple majority off the floor to pass. But again, since both are bipartisan, we expect to see robust votes on those bills. On the other hand, AB 1335, as you recall with SB 391, this is a two-thirds majority vote. This means for it to pass out of the assembly, off the assembly floor, in addition to all Democrats voting aye, we need 2 Republicans who also vote aye. And really, in the Senate, we would need all Democrats to vote aye and 2 Republicans to vote aye. You can do to help is, as the bills get released off of suspense, if you can call your legislators and voice your support for all 3 bills for your local legislator, that would be greatly appreciated. I'm going to go over our 5 targeted Democratic districts on AB 1335. And if you do work in any of these districts or have relationships with local government or business in those districts, please let me know, and we will plug you in to our robust district activities to help soften the ground locally to help these legislators be supportive in Sacramento on these bills. District, this is in the Central Valley in the Merced area, including the cities of Modesto, Newman, and Patterson.
I know series.
Next slide is Henry Perea's district in the county of Fresno. Henry Perea is a turned-out member. We expect district work to really make a huge difference with his vote because he will be more responsive to the district due to whatever next path he chooses in his political career. He also is the chair of the moderate Dem caucus. Getting his support helps us with many of the mod Dems. Next slide. Is in the Bakersfield area. He was in sort of a swing district originally. Into what moves him. So I know several of you have a lot of projects in Bakersfield. Let us know if connections in this district. Next slide. Next slide. Tom Day's district, I think the next one. And that is, he's in Orange County area. He has a lot of business support. The BIA and OPC have put into his district, so also important. And then we can go back one for our last district. That's Cheryl Brown in San Bernardino County area. Participant groups, homeless groups, and business groups. Her district would be great. I again know many of you have taken her on tours of projects. Our reach of coalitions in that district locally would be great. For the presentation, we have about 5 minutes. And so, Robert, if you wanted to open it up for a couple questions, just be able, we have only 5 minutes. And if you have a long dialogue or want to give feedback, please do offline. We just want to answer technical questions these remaining 5 minutes.
Unmuted. All right, everybody, in 1 second here. So. Is everybody good now? All right. We will have a few minutes now for questions and answers. Somebody.
If you don't intend asking any questions, please mute yourselves.
Okay. All right. Question and answers. So, does anybody have any questions? Oh. Oh. All right.
Identify yourself before asking the question.
Cool.
I don't have any questions, so Robert, give final steps and let everyone know where the webinar will be posted when it's finished.
What we will do is thank everybody for coming to our first WebEx webinar. I definitely would like to send a gracious thanks to all of us today. We will have all of the information to everyone. Okay, with the panelists, we'd like to also send a copy of the PDF presentation. And finally, we will also have a recording of this session available probably by later this afternoon. And the website it'll be on the front page at our SCAMP website at www.scamp.org. Again, I'd like to thank everybody. Any final words?
Just thank everybody for listening, and please, if you can follow up Marina's tips for how to help, because, well, we've gotten good support so far. All these, our package, we need more, especially on 1335.
Big push this month.
Yeah, this is our last big month for our floor votes on all of these bills in origin. So if you have not submitted support letters, please do so as soon as possible. And let me know if you have strong relationships in the 5 targeted districts.
I just want to double check the chat window just to make sure we don't have any more questions. Looks good. Okay, thank you to everyone. And we will have the information coming your way by this afternoon and include contact information if you'd like to have campaigns. Thank you so much.
Yeah.
Thanks.
I'm trying to figure